Boy, oh boy, a lot has happened today.
Yeah, you do look like that, Vinney.
I'm still smiling after, it's interesting, very interesting. This is my first property where the market went down, COVID, everything C minus. I bought 7 years back, I think, or something. And then COVID and moratorium on evictions, then challenges with the building, the leakage, the drainage, the pipes bursting, all that. I don't know if you've come across. I'm recording this. It'll go down as as something which I can be very proud of. Essentially, after 7 years or 6 years, I'm refunding my acquisition money, can you believe it, to my investors to give it back to them as their return of capital. And I feel like that's the right thing to do, anyway. And then not taking, we also invested 200,000. So not taking any, funds back. And what are we doing? A couple of more things we are doing to help the investors, Anyway, but not about me. Well, let's talk about, I think we can get started. It's almost, 4:07. Wow. So there we go. Go ahead, Ethan, buddy. Yeah.
Hello, everybody. So welcome to Vinney Chopra's Master Webinar, where we talk about topics of interest in real estate, multifamily investing, and syndication. This webinar is for educational purposes only. It should not be considered as legal, accounting, or investment advice. This webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The information presented is believed to be accurate and reliable. We make no representation or warranties expressed or implied as to the accuracy of such information. We expressly disclaim any and all liability that may be based on such information or errors or omissions thereof. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments, and specific tax situations. The quotes for this week are: falling down is an accident, staying down is a choice. There's no elevator to success, you have to take the stairs. Then don't wait for opportunity to create it.
This is so interesting. There is a good friend of mine, Corey Waden, I think is his name, and he wrote a book, Take the Stairs. I think it's called Taking the Stairs or something. He wrote a book which was international bestseller. I think it's still on that. He talks about you cannot take elevator to success quick, easy, but you got to take the stairs, and go through that process. I thought that just kind of reminded me. Yeah.
Yep. And then we have the book as well. We have the Spanish version as well, if you know anybody who would like that. And then Positivity Brings Profitability, which is a great read as well.
Yeah. Oh my gosh. We got an order today for Positivity Brings Profitability. I got a call from Jeannie Orlowski and Dave Lindahl. I'm recording this. And on their ultimate seminar, they want to give 1,000 of my books, Positivity Brings Profitability. So we just ordered them to be delivered to them so that they can put in the goodie bag for all their students, So because he's been my mentor, as you know, many years back, and I interviewed him lately also. And Jeannie, just a wonderful, so they want to feature me at their conference or whatever, that, what we have done, and then pass out those books. Yeah. Anyway.
Yep. And then we have the podcast on Spotify, iTunes, podcast on iPhones. And then we have the Vinney and Bo Show live every Friday at 9:30 Pacific time. And then, and then I have one deal today and then a few questions as well.
All right. Very excited, very, very excited. I think we want to make it crisp and nice and good, even if it's one hour, let's make it best, because I think it doesn't pay to drag, and I know we used to do it 2 hours, then we cut it down a little time. It's good because we need the best of the best, to talk about, get motivated. It's not the length of what we cover, it's what we cover inside, right? And answer questions and everything like that. So I think, again, positive news, I always start with that, or anything happening in your business or life you want to share, so please take away. I know I'll be presenting at Mercy's camp there. Mercy, you want to tell us a little bit about it? Yeah.
Absolutely, Vinney. Thank you so much. So exciting that we are going to have you be our guest speaker for Saturday, August 21st. I will be sending the link if you don't mind.
We would love
for
to
people
send
to register.
Everybody. Yeah,
I'll send it after this. So you will talk about senior living, taking down senior living community, and how to predict in purchasing the community. Correct? I want to make sure.
Yes. Yeah. I'll be discussing.
So I'm excited. Yeah, we are taking a few people are registering already, so we'll see.
Wonderful. Thank you. What else is going on in your field of property management, as you remember?
Yeah. So right now, my direct asset managing is pretty stable. The one in Wichita is pretty stable, and our team is in the acquisition mode again right now. So we are reaching all the brokers. But this time we are going to do a direct selling. So we will, having a VA kind of start calling one by one, and we have some prospect, skip tracing. Possibly I will contact Ethan, see if you have information for skip tracing the information, and I will go from there for Wichita.
Wonderful. If for the purpose of everybody understanding, Ethan, could you explain what skip tracing? Oh, somebody's got a dishwasher.
Okay. All right, thank you.
So Ethan, what's skip tracing? I'm sorry.
I believe skip tracing is when you have an address and you have to figure out who the person is who owns it and what their phone number is.
Yeah.
So sometimes people use it a lot for wholesaling. They find an address, then they give it to a VA who just gives them the number. And they just call them.
So they are going to call. Yeah, they are going to call one by one.
Wonderful. So you're directly trying to reach the sellers who will be interested in off-market deal coming in your lap, so that you could put an offer on it. And what unit types, and I mean what unit type, and also how many units in the multifamily?
Yeah, so we are looking something 40 to 80 units. That is our sweet spot. But somehow the one that is kind of presented to us is kind of small. Mm-hmm. So one owner with 20, 30, 16, 14. And in fact, we said, if you are open, we can purchase in portfolio, because they are kind of close each other.
Yeah.
We'll go from there.
Very nice. And it's going to be in the same area where you purchase.
Same area.
So economies of scale will happen.
Absolutely. Yes.
Very good.
Correct.
Very good. Thank you, Mercy, for sharing that. Yeah.
Absolutely.
Excellent. Anybody else would like to share any positive news or a challenge or something?
Quick question to Mercy. Mercy, I'm a new journey here. I'm here only for the last 1 week or 10 days. How can I make sure that I'm going to be in the list that you are going to send out, where Vinney is going to start?
Mercy will send it to maybe John or Ethan, and then we can send the link to all our students. Let's see how many show up. See, a lot of them kind of listen to it after the show, after the training. They're working W2, but then they might register to come there, Yeah.
And Ethan has spoken about Friday evening session with Vinney. Evening podcast or something.
Oh, it's the Vinney and Bo show Friday. So
that's in the morning. That's in the morning. Every Friday. Last week we skipped it actually after a long time. We wanted to take some time, some break, But it's 9:30 a.m. Pacific. It's a live show, which is live. You watch us, you can interact with us, you could put your questions and everything. And then many times we have guest speakers come in, and then it's live on Facebook, on LinkedIn and YouTube. So if you subscribe to our channel, it will notify you and say Vinney Chopra, Vinney and Bo show is on 9:30.
Okay.
It even says 15 minutes before, doesn't it? It reminds you, John. Is that right, buddy?
It
Yeah.
does. It'll say, so like, I love it because the notifications, because sometimes I'm working away and my phone will go and so I never miss it.
Yeah. So that's
Okay.
Thank you.
Okay.
Thank you, Krishna. Yeah. So anybody else has anything to share or some challenge in your business which we can talk about? Otherwise, we'll go to deal, Ethan's deal, and then we'll talk about some chapter, in our business, right? We could do that. Huh?
Yep. So Vinney, my closing is less than a week away. It's the 17th of August. So as of now, it's still the 17th. So everything looks good as of right now. We got an actual, Thomas hired a design company to do a whole design PowerPoint, and they sourced everything from the local stores like Lowe's and other places nearby. And then they broke it down in phases of the renovation. And then we give that to the contractor, and the contractor knows exactly what materials to buy and everything else.
Oh, wow. Would you like to share any aspect of it? We would love to.
Can you guys see my
Very
screen?
nice. Aha, there we go. Okay. Yeah, we see it. Yep.
So this is the phase one, and breaking it down into the phase. We kind of just give them a rough idea, and then they went off with writing all of this.
Mm-hmm.
And then this is the inspiration they use for the property, like colors and stuff like that. And then they have a rendering right here of the paint, what it'll look like. Right now it's like,
Wow.
yeah.
I like it. Ooh, looks very nice. So what was before? Can you maybe show us that too? Or maybe after this? Wow, this is beautiful. Go ahead.
Yep. So these are all the materials from there's a Lowe's right next to the property. So this is all from Lowe's.
Oh,
And then
they on their computer and everything, right?
Yep.
So I was at Home Depot all day today, and so I have all the blueprints. They do it all 3D, and so yeah, they're exactly the same thing. So and then every part list right here that you need, they build it for you. So it's a similar thing. So and if anybody ever does it, you should go there, and it's completely free to do. They design it all for you.
Oh, I love it. Please explain a little bit more. This is very good what you're sharing, I mean, without us putting so much energy and everything, just go to Lowe's or Home Depot, like John said, and they will do it. They have CAD CAM or something. They can even scan your picture of your apartment, I thought, right? And it just comes there, and then you can change the colors of the schemes to show you how it's going to look like without even putting a touch of paint. It will show you, right, John? Right?
Yeah, the best part is, so they have everything you need at Home Depot or Lowe's, so they part it out. So not only do they build it, the blueprints, the dimensions, everything, but then it's part listed. So then they print this out, and you can actually get better prices. So when I was shopping contractors, I'm getting all this for under 20,000 with everything. A contractor quoted me over 30 grand for the same stuff, and I don't even think it was as nice quality because they marked it up. So I have this, we're getting it all shipped to the house, and then I just have a contractor installing it. I'm saving 10 grand.
Oh, that's awesome. In few hours of work, John, you just saved yourself or earned 10,000. I mean, 10,000 not spent is 10,000 earned, right? Penny not spent is penny earned. Yeah. Oh, that's nice. Please go ahead, Ethan.
Yep. So this is what it looks like right now. And then, so they plan on painting it blue and gray.
Cutting edge. And the doors will be green color. I
Yep.
just saw. Oh, that's going to look beautiful. That's going to give a great facelift.
And this is the logo right here, Whispering Pines. And then they actually created a new logo right here based off of these logos.
Oh, nice. So who did this for you? Same people or?
No, so
different-
this is a company called ROI by Design.
ROI by design.
So we just sent them what our plan is for the renovations, and then they created the design aspect of it, like the appliances, the color scheme, and everything else.
Marvelous. Oh my gosh. Hold on. So they do all this for you, right?
Yep, and it was a few $1,000s. I think it depends on
But
how
it's
many
still
units there is.
worth it. Oh my gosh, Ethan, for us to spend time and really brainstorm, right? and not come up with the real design things, but hodgepodge, right?
Mhm.
It's much better to pay a few thousand and get a very nice, full executed design, which investors can really appreciate, I think, and we will too, right?
Yep, definitely. So even the furnishing for the office
Oh, wow.
and then the pool, like adding like a grill area as well. And then
Mhm.
Brent found a company that you give them the dimensions of your gym space, and like they'll they'll tell you what gym equipment you should put in that apartment.
Wow. Love it. So this is modern, very cutting edge. I
Yep,
mean,
and
those stairs and all I just saw.
we
Very
plan on
nice.
we plan on building there's two maintenance rooms that we're planning on like doing month-long leases for like travel nurses.
Oh, yeah.
This is for the unit as well, so it's like a longer unit.
Okay. So this will be like Airbnb kind of long-term
Yep.
stay. Yeah.
And it's another one. So it's more of like a studio,
Mhm.
or like a one-bedroom. So yeah, that's basically the whole thing.
Look at that. Oh my gosh. Good job. So for 4,000 or 5,000, they did this whole thing. How
Correct.
long did it take them to do it?
I'm not really sure. I kind of like sent them all the stuff and I kind of forgot about it, and then we got it back like today. So maybe like 2-3 weeks it took.
Sure. Local company? What was the name? By Design.
ROI by design.
Oh, return on investment by design. What a great name. ROIbydesign.com. Well,
So
for
I don't
3
think they're
cheers, 5 cheers for them.
yeah,
Wow.
they're not a local company, I think. Thomas knew them, so we did a call and then we sent them all the photos and everything else, the idea we had, and then they ran with it.
And they are located in California or somewhere else, or where?
I'm not sure. I just know not in Texas.
Yeah. And maybe they have VAs, international VAs, we call them,
Mhm.
virtual, and not virtual assistants, but international assistants, we call them now. IAs, VAs changed to IAs, But no, thanks for sharing. And oh my gosh, any questions for Ethan or John? Huh?
I have a question for Ethan. So how does it work? Let's say, are you going to order all those equipment, or you will turn unit by unit and then have them ship it, or how does it work though? Are you going to completely renovate all of them, or?
So we do plan on renovating all of them. I believe 16 leases
wow.
come up in this year. So we'll hit those first 16 once we take over. But I know it'll take a while for us to renovate all of them. Some people are going to want to renew their
Right.
leases, We do plan on moving people around just so we can renovate them all. But the way this works, we kind of give this to the contractor, and the contractor buys all the stuff, and we have it like the price and everything listed out from what store.
Okay,
wow.
got it.
But we don't plan on buying all of it. There's like furnishing that we don't plan on buying because we don't furnish the units ourselves.
Correct.
So but they kind of did everything, and then we'll just like take parts of it.
Sure.
I see.
Sure. And the external color, exterior paint, are you thinking to do renovations first inside, then do the external, or vice versa, like do the outside first to attract attention and everything? Huh? What have you thought about it?
Phase 1 starts first with the exterior model. So I think so, but I kind of leave that all to Brent. Brent's the one who does like all the renovation stuff, so I'm not entirely sure about that.
Sure. Okay. No, well planned. And how many units is this? You want to share, and when
Yep.
it was built?
So 104 units built 1978, $7 million. So that's 67,000 a unit. The building next door is the same vintage, and it sold for 83,000 during COVID.
Oh,
And they actually used to be one apartment, but got split in half. So we're pretty confident that we can sell it for like minimum 88,000 in 5 years.
Nice. And it's about 2 hours from Dallas, I thought. Or
Yeah,
something.
2 hours from Dallas and another 2 hours from Houston. So right between the middle of them.
Oh, wow. Is it in Spring? No.
It's Palestine, Texas.
Palestine. Okay. Spring is nearby there too, I think. I remember seeing Spring, Texas. Somebody's buying there. I
Okay.
know. Then I saw on the map, it was in between Dallas and Houston. I think, yeah. No, well done, well done. So any kind of challenges in the financing, and kind of share with us the good, the bad, the ugly,
So some trouble is we were basically fully funded, but we were just waiting for a few people to send their money. We knew that they had the money, that they signed the PPM, they just wouldn't send it. And I went to Aruba with John a week ago, and by the time I got to Aruba, we still had $350,000 missing from investors. By the time we left, everything was fully funded, but that was an issue. Some investors, they're always one investor, he's like always traveling to Texas and different states. So he was just never picking up his phone, and that took forever. And then he invested 100,000 instead of 200 like we initially thought. But we figured it all out. Everything worked out. Another issue is that the lender wanted 10% of liquidity for the loan. So it's a 5.8 million loan, $580,000. We approved the 10%, but now they want like double that. So that's like an issue that we're running into right now. And Thomas is taking care of that.
Okay, good. Wow. I'm glad you're sharing these ups and downs, and maybe Dr. Jose can also share something, because you are 50-50 partners, as I understand, right? With two people there, you are together. Yeah.
Correct. So the issue, I think, for this first indication is, I've been talking to people, to doctors. I went to the offices and they said, no problem, I'll do it. But when it was time to get the money, some of them changed their mind.
Yeah.
And I do believe that, because I have no experience, I have no background doing this, they were concerned. So I think I got enough people, to for this deal, but I think it will be easier to sell the next one.
Yes.
The next deal. Because, for example, for the COSEC, I wasn't sure how much money they might save. They asked me about what's my experience doing this. So I think that was the main issue. People that say yes, and the moment they had to put the money, they weren't there. They couldn't do it.
So
and people that
the financial situation changes from month to month to month, and maybe some other investments came on their way. We don't know, right? So you're so right. That's very challenging situation, even for somebody like me who raises money, people who committed, for the fund. We had to write up, John and I wrote up 4 people yesterday. We said, we have called them, texted them, all that. So, it's not going to come money in at all. So let's just we put them underneath in a waiting list. So we took them out of the Google Sheet. We have a Google Sheet where we keep record of how much money is coming in and all, and all those things, and bank transaction and all those. You've got to actually go back to bank. If somebody's wired the money, copy the whole transaction description. And it's good to do that, by the way. That way you will have a whole record of this investor, this time committed to it. I send the PPM, they DocuSign the PPM. It's all in the columns, right? You keep on putting the dates and dates and dates. What day I sent them the wiring instructions, or I texted it, then what day did they bring the money into the bank? That's the most important date. When the money came in the bank account of that LLC, and then the description. Did it come by wire? Then you have to copy the whole thing from the bank, the description, and paste it into the Google Sheet. So that's how we do it. We keep it like that, Maybe I might show a little bit, later on. I'll hide the investors' names, but then, it just keeps it all together wonderfully. And I think John can even share our Google Sheet. When they do soft commitment, it asks them lots of questions. Is it going to be 1 signer, 2 signer? What's their spouse name if it's a 2 signer? What's the LLC name? All those things are right. When they fill out the Google form, it gets transferred into a Google Sheet, and we see the time stamping when they fill that whole form. things like that. Maybe we can share in another session, but we have all kind of techniques that we use. But no, thank you, Dr. Jose. So that's definitely a concern. You're right. And not only that, things come in life, right? But I'm so glad that you are not stressing out and the money will be there, before the close. So that's important. But then why are they doing, Ethan, twice the reserves rather than only 10%? Now they're saying 20%. Why?
I'm not sure. Thomas sent me an email today saying that I think they're just concerned, and they're just like, they have a checkbox. So once they feel safe with that, we have the right amount of liquidity, that they'll just check it off.
I see. And even though Thomas and Brent have done other, not as big deal than this one, maybe? Is that their biggest one? 104 maybe?
I believe so. I'm not sure. I could be wrong.
I think they bought 28 units. I think John will know right after they joined my academy. I think they bought within a month or 2 months in Spokane, if I remember correctly, 28 units. And then after that, they did one more syndication, small one, but they have 3,000 units or something like that. When they joined me, I remember 2 years back. I think it's been 2 years. Yeah, no, that's good. Very good. Any other thing anybody wants to ask, Ethan? I mean, bundle of knowledge. What kind of terms you're getting? What LTV? All that, Ethan? Yeah.
So it's 4% interest rate. It's a bridge loan. So it's interest only for 2 years.
Very good. Hold on. That's music. Bridge loans are usually 5%.
Yep. So it's 2 years interest only with a 3rd-year option. We plan on refinancing after the 2 years. 25% down, and we get all the capex finance as well. So so $750,000 in capex. So the down payment's like 1.9 million, around that.
Oh, awesome. So capex money, the renovation money, is put into the loan balance after the 75% loan, right? Is that understood?
No, so technically we have to finance 25% of the renovations.
Yeah, 25%, because they added that renovation of 750 into it, and you only are raising 25%. So the purchase price plus the reno budget, total amount, and 75 of that is being given loan at 4%, 2-year interest only with 3rd year, refinancing, because you would have completed your plan and the rents would have gone high, NOI is higher, and now you are able to refi without any prepayment penalty.
Yep.
Right?
And
That's
then
the beauty of it. That's the beauty of it.
we got our cost segregation estimate today. I think yesterday or today. So 30%. So if you invest 100,000, you save 30,000.
Awesome. Did you go with Core Solution or somebody else? Or
whoever Thomas did it. Thomas adds them to the emails. I just sent over the information that they require.
Beautiful. So explain to us what you said, 30%. How would a regular person save that 30%?
So it's a paper loss deduction for the 1st year, correct? I think Harry's here, so Harry can talk a little bit more about it than I can, I believe.
Is Harry here? Harry is here. Hey, Harry, yeah. So if we get a cost deduction of depreciation, accelerated depreciation, which is bonus depreciation, so not only it's going to take out some points and all as a closing cost, right? Certain portion of the closing cost will be written off in the LLC account today, this year, because it is going to close before 31st of December. So for a property to close in 1 year, you take out all the expenses, even if it's December 31st, because it did close and you did buy. Even at the last day of the year, you get to take all the costs out. Even though with zero revenue, you can take portion of the closing costs, and you have to look at it, and all that. And then cost segregation, like Ethan just said. So, if they close, which they are going to close next week, we got 3.5 months at least to do some renovation, 16 apartments, right? So all that money that's put into renovation will be deducted as a paper loss because of bonus depreciation. Is that right? Harkrishan, you want to share something, buddy? Yeah, throw some light on it. Yeah.
So let me sort of wrap my head around it. So when you're asking the 16 units will get 100% bonus depreciation, only the personal property is going to get 100% bonus depreciation, not the whole cost, not the whole renovation cost. You're not.
What do you mean by personal Oh, like the purchase price?
No, when I say personal property means, Vinney, that any assets like carpet, cabinets, but if you put some ceramic tiles, any long life properties, they cannot get 100% bonus depreciation. But here's the catch, right? The catch here is some of the CPAs will say, well, you have 70 units, you're just renovating 16 units, and they might be able to apply safe harbor rules, which means that you can classify all these things as repair. I wouldn't advise it. It's really aggressive, and depending on how much money you're gonna spend on those 16 units, right? So if you're saying like I'm gonna spend like 200,000, 300,000, it's a capital event. The right way to do this would be doing a cost seg and finding personal property, and maybe if it's all interior improvements for those 16 units, I'm looking at about 40% of whatever he will spend will be taken as 100% write-off in the very first year. And for the closing, after he closes the property, the whole purchase price is, I would assume about 14 to 20% he will get a 5-year property.
I see. Okay.
And depending on how big the site is, he will get. I'm not sure how big the site is. If once I get the site improvement, I would know how big. After I know how big the site is, you'll get it. Oh, so KBKG gave you the. I used to work here, by the way.
Oh,
that's funny.
Yeah. Now
tell us. Okay, can you explain this?
Yeah, I can walk you through this because.
Let's do it.
I used to do this all the time to my clients when I was there. So can you give me the control, Ethan, and I can walk you through this.
I'm not sure exactly how to give you the control.
Okay, let me ask for it.
Let's see.
So I just requested control.
John,
Okay.
can you give control of this worksheet, which is actually Ethan is sharing?
Perfect.
To her. Oh, you got it? Yeah.
I got it. So it's funny how world is so small. So the first sheet that you see here, Ethan and Vinney, basically what they're showing you is they're saying that, okay, this is the acquisition of the property, and these are the improvements of the property. So what they're trying to show here is in the very first year, when you're doing the cost segregation study, they're saying that this is what they're estimating as deductions in the very first year. And over the highest estimate is always, they say 25% of this amount, of these two amounts.
I see.
And the deductions from 1 to year 5, they're saying from year 1 through year 5, this is lower because obviously you're getting everything in the first year and then you're catching up for the last 4 years. So that's why this is low. And this is cash flow. Cash flow is basically, you just take the number, depreciation deductions times the tax rate. It will give you the cash flow number. And this is the net present value. It's just a simple formula. Over the period of time, is it valuable for you to do the cost seg or not? That's exactly what this number is. There's nothing special here. And what this means is 46-1 is basically saying every dollar you're spending today is basically returning you $46 in the future. So this NPV is linked up to this. So if you do the study today, you spend 11,500. This is basically giving you 46 times the return for the future. And this is basically saying that they're charging you 11,500.
Yeah, that's a lot, isn't that, Harry?
About half that much.
Well, listen, guys, you gotta understand. They would have people like me and directors. They need to pay them. How would they pay the directors if they're not gonna charge you that much?
Yeah.
So yeah, this is on a higher side for sure.
It is higher, I think.
Yeah.
I don't want to bust the bubble, but
we haven't paid yet. So Thomas is arguing them with the price, negotiating.
Oh yeah, okay, good.
I think he asked for 5,000 or 6,000.
Okay.
Yeah,
Maybe we can get your core solution works with us, and it's amazing how we know the president, right? What's his name? Terry, and so they're very competitive. Also, I don't maybe Har Christian knows them or not, And I know Yona Weiss is another great friend of mine.
Yeah, Yona Weiss. He's in medicine specs.
Yes.
And then you have Core Solution. One thing I would tell you guys though, I mean, all of these guys are obviously in my competition. I don't want to put bad mouth towards anybody. One thing I would say is that with apartments, they are under scrutiny because the IRS has obviously hired a lot of people now, right? So the good thing is when you're gonna go with a provider who is obviously telling you that there are some risks when you're doing some aggressive positioning. I can tell you if they've taken that into account. Yes, they did, because they're putting this as 8%. They're putting it at 8% because of the improvements that you're doing in the first year. So are you telling them that you guys are doing improvements for this much in the very first year?
Is the first year, I mean the first 12 months or like?
Right, the first 12 months.
Okay.
I believe so, yeah.
Okay, gotcha. So this is how much you're gonna spend in the first 12 months. Like the very first, so from next week till December 2021, you're not gonna spend this much money.
Yeah.
Right?
No, this is
Right?
for 12 months.
Right. So over the period of 12 months, yeah. So they're conservative. These numbers are very conservative based on what they're putting right here, because you're just improving 16 units. You just told us, right? Another thing that they're missing right here, right now, Ethan, is you should go back to them and tell them that, hey, listen, what about retirement dispositions? Because when you're taking the assets out, right? Because after this fiscal year ends in December, any improvements that you do from January 1st, 2022 till December 31st, 2022, you can literally write those assets off, right? So those assets should be taken out of this basis. And there should be a retirement column too. And that will really increase your deductions. But they have taken a conservative approach. So you'll easily outbeat these numbers, 100%. But I don't. So should I just go back and ask them about the retirement depositions? Yeah, you should tell them, hey, listen, we're also getting rid of the assets based on these improvements. All these improvements are going to be done in 2022. Why are you not giving me retirement deductions? So whosoever put this proposal together maybe overlooked this stuff.
Okay.
So you ask them.
You check the box.
Yeah. Right. So who are you talking? Who are you talking at KBKG?
I'm not entirely sure. I was just told to fill out a form, so I filled out the form, and that's all I know. And then we got this back today.
I see.
I got you. You basically probably working with one of my mentors, Eddie Price.
I see.
He's a very good guy.
I don't believe it's. I'll about double check. Let me see.
Maybe you're working with the business development. Yeah. They're salespeople, so they don't know from the technical side of things. From technical side of things, I think probably Eddie Price is the person who's going to be working on this project because this is in Texas. But he's usually conservative. This probably was reviewed by Eddie. He's one of my mentors.
Retirement, is it depositions or deductions?
It's called retirement dispositions.
Dispositions, okay.
Dispositions.
It's because they are planning to refi it in few years and sell it. Why are we saying retirement so quickly?
So Vinney, the way it works is this. When you read publication 946 says that if you acquire a property, right, and then you hold that property for a good 6 months, or let's say you acquire the property and you take out all the assets right away in the very first year, you cannot depreciate those assets. So let's say if Ethan bought this property, he basically demolished everything in the very first year. You wouldn't see anything in 5-year property. Technically, you can depreciate it. That's what publication 946 says. Now, the issue comes, it becomes a gray area. A lot of people will start saying that, well, okay, if I don't depreciate it, then I paid for this asset. Didn't I pay for this asset? And the answer is yes, you did pay for this asset and you paid it at the fair market value. And they're going to be like, well, if I paid for it, then I will be getting retirement disposition. That means that I paid for it, but I right away took out, those assets. But here's the catch though. IRS is going to be like, okay, if you took it out, you're just taking the salvage value of that asset. You can't take the whole value. So right now, the 8% is basically means that, there is still something that is in the property that's valuable. So what I always tell my clients is that when you acquire a property, try not touching it for like good 3-4 months. At least it will go on your books and it will start generating some income. At that point, you can argue with IRS if there's an audit. Be like, listen, I am getting money out of this asset. How are you saying that this property doesn't have any value? But if you're not collecting any rent of those units, which you just got demolished, then IRS has a case against you. Be like, you are not collecting rents against those units, so you cannot take the full value. That's the issue. But now, what an interesting fact that I'm telling Ethan here is that, okay, I can go back to IRS and argue with them. Out of 70 units, I only got rid of 16 units in the first year. That's why my 5-year is low here. However, what about the other units that were part of the acquisition? My tenants use those units for a good 1 year, or let's say 7-8 months. Hence, there should be another column called retirement dispositions, which will be here, which will increase his basis, meaning that his deductions will go higher, because right now what you're trying to say is that over here it's going to include about, let's say, 3 to 4% or 5%, which we're saying that in the next year he will be getting rid of it, those assets.
All right, thank you so much.
Thank you, Harry.
Really great, super lesson on acquisition and the ups and downs and collecting money, getting the money into the bank, and of course cost segregation. And
so basically in the very first year, Ethan, you're going to be getting $1.1 million in depreciation deductions.
That's going to make K1 very negative for everybody.
Right.
Yep.
That's exciting, very nice.
And your cash flow is going to be $430,000. So
see.
That's the lower side of things, and this is the higher side of things. So cash flow, just remember, whenever you see deductions, you're just multiplying your your depreciation deductions times the tax rate. Another thing, you can throw a curveball at them. Hey, listen, which tax rate are you using?
Yeah.
So and the tax rate always
combined tax rate 42.9.
Right. So what they're doing right here, Vinney, is they're using state plus federal. Right? They're using state plus federal, and they're assuming the person who owns the property lives in California.
Right, which is not true.
Which could be true. I'm not sure what the situation is, Ethan.
Florida, there's no state tax.
Right.
A lot of investors are from Florida.
What was the question?
So you should ask them that the tax rate that you're using based on what?
Okay.
Usually what they do is if a CPA reaches out to them, then they use the CPA state, because they just automatically assume the CPA lives in the same state as the client does. And then they use that tax rate, or they assume that, okay, California is a higher tax, so let's just use that just to be on the conservative side.
Okay.
So do they use like the tax rate that most of the investors are from, or the general partners?
The tax rate always follow who the property belongs to. So I believe it should be general partners.
Okay, so half the general partners are in LA, the other half are in Florida.
Oh, they are.
So I mean, for conservative purposes, then you should, I think, let this be.
Okay.
Whosoever is your CPA, maybe that he could probably answer this question better. But in any scenario, you will still come out better, because they're assuming right now everything is in California. So if there's no state tax in Florida, you'll come out better.
So I have a question. If we are taking 1 million something deduction, paper deduction loss, minus other expenses, to run the property and all. So net effect of the K1 might be minus what percentage of the original amount?
What percent of the
original amount? Is it 25% that they will see negative, that they, what am I saying? Like we say in our one deal, 100,000 investor got minus 61,000, in my case. I bought it in December. The
Mhm.
Princeton Park is the property in Florida, Melbourne, Florida, right? So my investors who gave me 100, our CPA with cost, segregation, everything showed minus 61 as net income loss or gain in the K1.
I
in
see.
box
So,
number
so
two.
they're probably doing that with the cash flow. So they're probably doing the cash flow, showing that this number right here. So depending on how much so it all depends on how much income you have, right? So right now, what COSEC is assuming is you have at least $430,000 of passive income that you need to offset this number from. So if you have more income than this, obviously you will have to pay taxes on it. But if you have less income than this, those cash flow can obviously move forward. So it can be, hence you're saying it in the negative sense, right? So if let's say your cash flow, your income is about 300 something, right? Then you have additional cash flow of 130,000, which you don't really need. So that goes forward to the next year.
I see.
From cost segregation perspective.
Okay.
And the same thing with the deductions.
But the deductions, that's what I was thinking. What will be the 2021 tax paper loss in this case? It'll be 1 million something, right?
Correct. So it will be 1,019,797.
Okay.
So this will explain actually a little bit more better. So just to read this file, a lot of times because people don't explain them. So if you look at this is the year 2021, right? And it's showing you that this is the depreciation expense in the very first year. So this is what the numbers you're looking at. 1,019,000. And then starting next year in 2022, you're sort of, paying it back to the IRS because of the 100% bonus depreciation. So it shows you by each year, 2021, 2022, 2023. And then in improvements, that will show you from 2022 because the improvements they're showing that it's being placed in service in that year, which is this year, 2022. And these are the depreciation expenses. So next year in 2022, we're looking at 158,676, right? Minus obviously these numbers because you're sort of giving it back to the IRS on the acquisition side of things. But obviously these numbers will change, Vinney, because they're going to include the retirement dispositions here.
Oh yeah, okay.
Right. But when you're gonna ask that, Ethan, they're gonna increase your price a little bit. So you might go the other direction.
But that 11,000 is kind of high.
11,000. Yeah, 11,000 is. They definitely have increased their pricing, and I would rightly so, and I'll tell you why, Ethan and Vinney. What I was coming towards the quality and stuff, and I'm part of the same organization, ASCSP, American Society of Cost Segregation Professionals.
Yeah.
All of these guys are certified, right? And a lot of times when it's ASCSP certified, the chances of your study getting audited is very less.
Very
because people are looking at it like, okay, you guys know what the hell you're doing, and it's the person is not just sitting out of the garage.
Makes sense.
And it's a lot of this is sort of like insurance built into it, whereas people are like, okay, it's KBKG, or and it's a known brand. I'm not gonna talk crap about my competitors, but
excellent. No, thank you. Thank you. All right. Oh, wonderful. Wow, we have been in it almost an hour so far. What other things can we say, and talk, and any other questions on somebody's mind?
Vinney, I have a quick one. I was trying to, sorry, I couldn't get to it before. You guys sent us that deal in Phoenix for 72 units, I think, right? And I wanted to just start doing the underwriting, and I realized that it did not have the purchase price on it. So
determined by market. That's how all the sellers are selling nowadays. They don't give you a whisper price. They might give you a very high whisper price, to be truthful. If you talk to brokers, that's how they're doing. They're asking everybody to rise up. And once you rise to the top, then they do best and final. Then they want you to go even higher than that. Okay,
wow.
then they say, now let's have a call with the seller, and they butt each other, two people, and say, okay, what's your best now? Hold on. So whisper price hike, then best and final hike of the price, and then best of the two hike again. It's
Jeez.
ridiculous what's happening in the market, you know?
Jeez.
It's just, it's really crazy.
So I can just put any price to just do the underwriting?
Well, yeah, you know, you want to do, maybe, you know, talk to the broker even. You know, it's good to do that thing, even if you may not buy. But if you're doing underwriting, right, John, buddy? Yeah, go
So
ahead.
on that deal, I asked the broker what the price guidance was, and I think they said right around 200K a unit.
Okay,
I
200.
see. Gotcha.
And so it's up there, but Phoenix, so like you have to, so 200K sounds like a lot, but the Phoenix area, that's what stuff's trading for there. So it's crazy. Like when I first heard that, it's like a B- asset. I didn't look into it deep, but it's not that nice. And I was like, holy crap, 200,000 per unit. But that's what they're saying. And you know, there's other assets that have traded higher than that recently, and they're the same vintage and everything. So I was like, holy crap. But yeah, 200K was the whisper price.
200. But please do it. Thank you so much, Harry. You know,
Yeah.
do it and then present it next week. I think that'll be amazing, you know, for us to do some samples, you know, and all. And the deal, Ethan, that was the deal you were talking, or you have another deal you're going to do the underwriting, buddy?
No, I have a different deal I have to show.
Okay, let's do
Yep.
it. Oh my gosh. Wow.
We do have some questions first, some student questions. Can I find any good deals on LoopNet?
Okay, good point. You know, it's interesting. Many times you don't find any good things on LoopNet, but I have to say that sometimes people never look at LoopNet, and guess what? The seller wants the broker to put it on LoopNet. You know, the seller says, CoStar, nobody can afford it. You know, I mean, nobody will get exposed, the big ones. So the smaller properties, smaller unit properties sometimes show up on LoopNet, by the way. You know, 10 units, 8 units, 12 units. So I wouldn't mind, you know, if you go to LoopNet and the city's name, right? And then you say multifamily for sale in the Google. Let's just go to anyone. Maybe, John, if you can take it to some place, it'll be good. We are recording it. You know, we could go to any place. Let's say even whatever area you might choose. There we go. That's LoopNet. And
Let's do Sacramento. I was doing Sacramento on this.
You were? Okay.
Yeah.
Sacramento. Yeah. Let's see what's out there. Sacramento, California. Let's see what shows up. And 0. No. Oh, there are quite a few. Hold on.
So really, for my purposes right now, what I'm looking at is honestly at like you know, we talked about it earlier. I was just looking at 4 to 10 units.
That's it.
Yeah.
Exactly. There is 4 units right there, buddy.
Right.
Let's click at. Yeah, click on
So I was looking at that one actually, 10 unit
You were?
apartment.
Okay. Yeah, look at this. Wooded and all, and vintage. Oh, Spencer Moyer. See, that's what you want to get from the LoopNet listing. Who is the person? Who are these brokers? See, they are off the cuff, alive. That's their company's name. And they are the ones who become specialists in getting in the smaller unit market. That's the one you want to build friendship with. Then you look at another deal, they might be different brokers, right? So it's good to build relationships with the brokers that are in that segment of those group types. Yeah.
And Vinney, what I used to do is I used to type my criteria, and I would call like somebody like Spencer, and I would let him know that maybe this property doesn't meet my criteria, but if you had anything else that matched a similar
Yes, right.
criteria, to reach out to me.
Yeah.
Exactly, Ethan. Wonderful. You know, and Ty, Spencer is on the top, Ty is at the bottom. That also carries some weight. So you go to the first one on the top. You know, you always go to the top because the top they get to know the deals first, by the way. They're then having their assistant do the package and things like that. So it's both very good. But look at that C-class building, $1 million for
And they're all studios.
all studios. Wow. 400 square foot only. Aha. But it's 10 units. So it's 105 a door. But what's the crime rate in that area? Can we do quickly? Where do we go? What's the best place for crime? Finding the crime maps. Come on, somebody should say, because it's in the course.
You can go to Trulia, spot crime.
Yes.
Trulia, Neighborhood Scouts. John, there is another one, Maxi Tax. What was that?
I forget the name, but yeah, if you just Google it.
Maxi or something. Oh my God, I should remember it. Crime rate. Maybe I put it over here as in the crime rate, you know, because sometimes I just put a lot of things in my computer right here, iPhone.
Oh, I guess you have to pay for it.
Oh, is it? Yeah.
I know there's Justice Map as well, but I don't think that tells you the crime.
We can look at nearest Starbucks.
So if you're just looking for a crime map, you can just go to Trulio. Just type in the address and just scroll down to Trulio. It'll give you kind of a crime map on there. And you can go to City Data too. They kind of have the crime statistics. They're not real robust about the crime, but sometimes you can find it on there. Neighborhood Scout is really good too.
So what exactly do you look at on Trulio to find the crime?
Oh yeah, right there, right? Huh?
Daniel, can you hear me?
Yeah.
Oh, sorry. I didn't realize I had muted myself.
Okay,
Yeah, so
there
if you
we
scroll
go,
down a
Daniel.
little bit.
Yeah.
Did you type the address in?
Yeah, the address is in, yeah.
Okay,
Well, the
scroll
zip
down.
code is.
I think
don't
it
think it
does
does
at the bottom. You have to go way down, scroll.
Yeah, scroll
Truly, I
down.
remember.
Scroll down a little bit. I don't
Yeah.
think that's it though. You'll probably have to type the address in the search bar
The real
You want
address, yes, you have to.
in the Google search bar, not the Trulio search bar.
Okay.
Oh, there you go, right there. Should be right. Did you find it?
Yep.
Yeah.
I think you have it on
No,
the screen.
it's the same thing.
Yeah, just go down. There should be a crime. See those 4 little windows right there? The one on the right, I think, is a crime. You passed it. Go back up. Go back up.
Okay.
Right there.
Yeah, look at that crime. Yeah, I remember. I used
Right
to.
there. See those little 4 icons?
Oh, look at that, guys.
Thank you,
And
Daniel.
it's free. It's totally
Yeah,
free.
absolutely. Totally free. Yes,
Or
sir.
you can check theft, assault, vandalism,
Yeah,
burglary.
everything.
There you go. Yeah.
So it seems like
I don't
pretty
know
low
how
crime.
accurate that is, but yeah.
It's very accurate too. I remember Trulia was the one I started, but then many came. Neighborhood Scout, this one, but you have to pay money at certain, but Trulia is free. Yeah. So darker is the hardest hit, right? The highest crime.
Yeah,
So where is the property, by the way?
right here, where this little house is.
Which is the lighter side. But on both sides, it's like medium to high, right? So if you look at it, it's not that far from this property. I don't know what the legend says, how many miles between these two. Doesn't look too far.
It looks like 2 blocks over.
2 blocks away, literally. I mean, you know, this is a C property in a D area, we should say, right? Yeah.
Yep.
You know, so that's why maybe it's a little bit lower price, 100, whatever it was, 105 or so, because I was told in the Sacramento area about 150 average, you know, is I know Elijah, my good friend and also student of our academy, Elijah Corey fan, you might know. He's bought, you know, the fourplexes and all and others, and now he's trying to get into bigger deals there. Yeah. Okay. Alrighty. No, that was good. Good question. And
real quick, just a follow-up question. So, Vinney, this underwriter tool, obviously, I'm assuming you can even use this for duplexes or fourplexes, right?
Oh, wait a minute. You could use it for everything. Why?
Right.
You just save a version of it, and then you could just take these columns out If you don't, or you can put 00000. Just do the duplex. If there is two separate areas, then you just put one flat or second flat.
Yeah,
so
if you go to the row on the far left, you can delete as many rows as you need.
yes,
to.
many
The
rows.
The formula
Yeah, we did
it'll-
not lock it in. Yeah,
it'll repair itself once you've saved the file.
totally.
The formulas and the totals will they'll correct themselves.
And to answer Harry's question, I used a similar underwriting sheet to buy my 8 unit that we
Oh,
bought
did
like
you?
3 years ago. So it was Dave's sheet. So it was literally just this one underwriting sheet, nothing else. There's no 5-year projection or anything else.
Okay.
Gotcha.
Yeah, no, I love this. I love this underwriting sheet. I've used so many models. I mean, I have about 6 in my data thing that everybody likes to look at. Different sponsors and different people look at different things.
Yeah.
But I always go to default back to Vinney's underwriting models.
Oh my gosh.
Even-
Hey, thank you.
Yeah,
thank
no,
you.
that's what I'm most comfortable with, and I like the way that it does. I understand it the best, even with Parag's
Oh yeah,
platform.
Parag, by the way, I think Parag took ours because we are trying to do something special with him. I don't know if John can even share. He took our underwriting and put it on his platform. We okayed it, and then we might be promoting it too, by the way. We want to be very clear with everybody. And then you could take any P&L, any rent roll in any even written form, you scan it in and it goes into my underwriting. Oh my gosh. So it puts all the numbers in there. I think John had to go somewhere, but he
I'm
might.
still here. I can share if you want.
Oh, you can, if you can, John. I didn't know. Yeah. This is very good. We are so excited about it because it's going to save so many hours of time, and it accurately puts this. John, please go ahead, buddy. Yeah.
So I love it because all you upload is a rent roll, T12, and then you just kind of put the date. So literally upload it, put where the dates are from, click property report. And so we're still working out the kinks for Vinney for their template, but it's going to autofill all the information. So
Oh my gosh.
So the rent unit mix. So this did it right here. So the square footage, monthly rent, market rent, the underwriting, it uploads everything in the sellers categories here. And so there's 1 or 2 minor kinks that they're working out, but it's very simple with Excel to fix. And then you come in here and put your numbers. So, get your insurance quote, repair and maintenance. I mean, yeah.
So that's you guys already have uploaded it to the site?
Yeah.
Or do you have?
We did because they're making a portal, and I invested in this company. I want to be very upfront with you guys, and
that's great.
I just flew last week, I think, or 2 weeks back to Bay Area and met with me and my partner Anshu Bansal, who is in the startup business, and we might be helping him to take it to IPO on the NASDAQ or something.
Oh, that's great. That's great. No, congratulations, Vinney. That's amazing. Have you met Parag's partner?
I didn't meet him because they live. Partner is his brother, and he only flew to meet us here in the Bay Area. He flew all the way from Toronto, and he got a very big contract. By the way, his software is being used now by big lenders. I don't know if you all knew that. You knew probably, Daniel. I don't know. Yeah.
I knew. Yeah, I had an idea. Yes.
Yeah. And
his brother's amazing, though.
$100,000 contract for the year, $600,000. So all these big people, I am introducing him to some very big capital stack people and all that, And I know the founder's son of Greystone, right? Is that the one? They give out 12 billion to 18 billion. I met with him 2 years back in his office in Manhattan. So I shared with him, and he was trying to get into it's kind of exciting,
Those are the big boys.
I already sent some money to invest in his company. Yeah.
Those are the big boys right there. The Greystone guys?
Yeah. Greystone is huge. But no, I'm so glad you said it, that you like this format, the colorfulness. It's easy to read, to be very truthful, I mean, I got from my mentor the one underwriting sheet for $30,000. I want to be clear with that. But I added more and more things to the right, to the mortgage, to the whole thing on the underwriting. Then I kept on adding more and more and more at the bottom, the assumptions, the first year, the 5-year projections. Of course, John did 10 years, and then, the unit renovations things, and then additional value adds and equity returns on. I designed it because I needed something simple so that I give it to a VA, they snip it up and put it in my investor packet. So I did it for my sake as a system so that I don't have to do it again and again and again. And if I just change one thing, it changes everything. And then my VA would put snippets of it in the, I did like every 2 months I did a syndication. So one time I did 10 syndications in 2 years. 10 syndications in 2 years. Yeah.
So quick question, Vinney and John. So when you guys are uploading this, so I know you guys told me, like, in the videos that don't follow the OM numbers because it's just a
totally
right. So when you're uploading this, so they're taking the numbers from the T12?
Actual T12, which the sellers gives you actual numbers, not the pro forma numbers which are in the operating memorandum. Hurry, right. That's what you're saying. But correct. You ask them, hey, give us the actual rent roll as much as quick as latest as end of July. Now it's August, right?
Understood.
End of July. That's the one you put into it, because that will get you the right rents. They'll get you the right numbers and all the things that you need in the rental. And then you also need the square footage, see? Because square footage should be in that rent roll. Many rent rolls don't have square footage.
Right.
So you need to find from them the one in PDF, Excel, whatever format. I think it's called click.ai, but it's going to have a different name for us. So it's going to be loaded up as vinnychopra.com/click, John, or something, or underwriting.
That's what we're doing. Yeah, to change the domain. Yeah. So we're
domain. So they're changing it for our system, and then you can get it for the whole month at a very low price. If you press smile or something as a code, you get $100 off for the whole month subscription. Which is a very good thing, because if you use for so many practices and all that, unlimited, they are doing it right now, unless we abuse it. Their platform. So you could do as many as you want for 1 month, and then you can cancel anytime. They're trying to do all that. Usually people pay $750. I think the other lenders, $750 a month or $1,000, or some big lenders pay for the whole year, $500,000, $425,000, $100,000 I'm talking about, right? Because then all the lenders throughout the country can use that license or something, but I understand. But ours will be, John, very low, right? It's like $299. We are trying to squeeze even more and more.
Yeah, and you guys will love it. So, like the underwrite, boom, you put it, so it saves you so much time, night and day. And so we're working out all the kinks, and as soon as it's done, you guys will love it. It saves so much time.
Yeah, totally. So when you're going to underwrite a property and you have to go through the unit mix, a lot of times it's a lot of work, and it's very time consuming sometimes if you don't know how to use Excel very well.
Yeah.
Like if you're anything like me and you're kind of tech illiterate, it takes you a long time. I've gotten a lot better at it, so I know how to use the filters now and the data, tags and whatnot. But I just learned how to do that. So I've spent a lot of time on underwriting throughout the last couple of years. And but now, this is totally amazing piece of software that they have, that they're implementing your spreadsheet onto Vinney.
Oh, that's nice. Yeah. Thank you. No, I know for sure, because sometimes, there'll be so many different plans, and then you have to look at it on the left screen and make sure you put the right information in the right column. And it's very time consuming for sure. And of course, by having that inserted within a minute, you are ready to do some good thinking and planning, rather than get tired of just putting the data and you say, okay, I'll come next day tomorrow. Then I'm going to analyze now. I'm totally brain freeze, by putting this whole P&L into the seller's columns and putting the, rent roll. Those are the two things which we need, the most accurate data and not make any mistake in it, right? So that's what, John, they guarantee or something, isn't it?
No, well, so artificial technologies, so I don't think there's any guarantees, but artificial technology is doing it for you. So like human errors, computer can do something better than we can do, it minimizes errors.
Yeah, that's why they call AI, artificial intelligence, and they have uploaded, I think in this model, thousands of P&Ls from what I heard, and thousands of rent rolls in all different ways. Like, there are up and down footers and headers and dates and all those things, right? But their AI software, which they have perfected over 3 years maybe, now it just, Okay, what's the next question, if there is any? Or we can do time out and happy hour time.
So next question is, can I invest my own 401k into my syndication?
You cannot. It is arm's length. In other words, in our culture in USA, IRA money, your 401k, your retirement funds, you cannot invest at all in your syndications, because they say, and even your family, isn't it true? Your brother,
family can't either. Yeah, direct. So like father or your brother, sister, son, or daughter.
Yeah, they cannot either, because they say you can manipulate. Oh my gosh, that's the word, that you can manipulate the operation of the property or something. I don't know, something like that. There is a very big write-up on Pensco and other places, we could look at. Thank you, Ethan. Yeah, so we cannot. Yeah.
I have a question. Oh, go ahead. I'm sorry.
Go ahead.
I have a question about development. So when you guys go into your developments and you're looking for capital to do your developments, I know the margin is probably pretty high when you guys do your underwriting and whatnot, from building to selling point.
Yes.
And so, what do you guys offer like your investors to get them interested? So I guess I'm asking, what should I offer investors just to get them interested from an emerging syndicator's standpoint?
Good point. Very good question, Daniel. So this was the same thing I faced myself, because almost all of 370 investors of what we had, last year, and many of them, 260 were active investors or whatever, who have been in my deals where I close the deal. Like today, I start paying cash flow tomorrow to them. All right. So they were used to getting it paid, their cash flow of 7%, 8%, 9%, starting the day after the closing, because the asset was making money. It was cash flowing. It was a momentum play. But in the construction, in the development, there is dirt, or there are just blueprints and everything, right? So
Sure.
What we have tried to do, Daniel, and again, I don't know if you are ready to investors to bring money when you put shovel in the ground, or you want some money from the investors even before that when you are developing it. You mentioned the word develop, which could be all the different drawings, architectural, passing through the hoops for ordinance changes, all these meetings at the council meetings, to talk to the neighborhoods, how it is, all those.
Yes. Yeah. So today we had our site plan review, which is just the very first meeting with the city.
Okay.
Which is free, So we go in there and so in 2006 the plan was approved with the zoning that was in place at that time. But since then the city zoning has changed just a little bit, not much, and some of the rules or regulations have changed just a little bit. So they're asking us to adjust a couple of little things. So we're looking for some upfront capital and a little bit of...
Oh, I think we lost him.
Yeah, I think you cut out, yeah.
Yeah. I was going to say, John, something really came very good to my mind today, buddy. We are going to start putting this on, maybe let's do for 1 or 2 weeks, this on YouTube and also on iTunes. 1 or 2 other people who are really successful, in their coaching, master coaching. I think Lane is one, by the way. I heard him on the, iTunes, but it was like the whole mastermind session. So I think if you don't mind, we'll tell Ralph, we know the audio is already there, right? So we just put that with the thumbnail. Can we try that, please? And let's do it, because I really believe what people will learn from our hour and a half is immense, and then we can have Rolf. Let's send this podcast this video from today, if we could launch it on YouTube also and launch it in all social media. Let's do that. I think it'll be well worth it. But, and again, this will kind of give a flavor to the people, and they can learn from it, see, and we could definitely say, I'm saying it right now, by the way, if you're watching us on the iTunes or, whatever it is, Stitcher or other place, please do watch us on the YouTube channel so that you could look through the drawings and the sharing of screens and all the things we covered in this, podcast. Actually, we are trying to do it new, which we do it every week, Master Coaching, Elite Master Coaching, here on Wednesdays. So we would love to bring this into iTunes. Let's do that, because we are kind of falling behind, getting our iTunes launches, This will be good. We are duplicating, triplicating so much stuff. And then, what's the word? On Fridays also, when we do the live show, we could put that also into iTunes. Let's do that.
Sure.
Yeah. Thank you. All right. So what other question? Oh yeah, developer question. I thought Daniel left.
Yeah, he cut out.
Maybe he's in the car, I know. So he got cut off. But what he was talking about is right. He's had the council meeting and all that. Lot of angry people around that lot are going to say, no, we don't want it. Noise and this. And, the construction is going to go on for 2 years, whatever. It's going to be obstruction from my house, all that stuff, right? So you have to pass through all the hoops, then give the architectural drawings, which we're going to show to the community anyway, to the city, building permits. And then they will say, okay, all green lights, everything is done. Now you could engage money from investors. That's the right way to do it, because you can be in trouble. Let me tell you why. I came across a syndicator who was telling the investors, hey, we're going to start in 1 year. So I'm going to pay you after 1 year. But guess what? He was starting just from scratch, the whole development. And that got pushed now. And now it's going to be 2 years. So investors gave the money to the syndicator, and then he had to go back to all the investors and say, sorry, I can't pay you in 1 year. It's going to be now 2 years down the road, you will start getting your cash flow. Wow. So that can happen. Of course, then they have to go back, and do amendment to the operating agreement and the PPM and all that stuff. I'm not an attorney at all in any stretch of imagination, but they had to get it okay from all investors that now they will not get the cash flow when the syndicator group promised them. But in our case, I would love to share with you, we actually buy the land, do all the ordinance changes, we do, all the permits. When we are ready to put the shovel in the ground, that's when we raise the money from investors. And our assisted senior living, we try to build it in 12 months so that we could start occupying the, building to bring cash flow as soon as possible. So, I think maybe that was the answer that Daniel wanted. But, the key thing is you got to sweeten the pie. That was the main thing. Because if we are not giving the investors any cash flow from day one or for 1 year or for 2 years, you got to give them high cash flow right away after that. instead of 7%, you might give them 9%, you know, in the second or third year, and 10%. That's how we did it. Right, John? We did like 9, 10, 11 or something. And then we said preferred return of 34%. Oh no, 43%, I thought.
Yeah, it came. So what we did, Daniel, so we wanted to get the average annual return to competitive rate. So even with year one, no cash flow, it made up for it with the equity. So if you averaged it out, it was 18, 19, and 21% averaged out. But if you looked at it each year, 0, 9, and 10, and then each year it got higher.
Exactly. So Daniel, that's the right way to do it, to get your investors to say, okay, it's going to be more than what 6.5 I'm getting, or 7% I'm getting for 100,000 in 2 years. Oh, there is coming back. You know, that you are, Daniel, we were just talking about you, man. So you have to go back and listen to it, because we covered a lot. But the key thing is you got to sweeten the pot for investors, because you can't pay them first year, maybe, or year and a half. So you have to tell them in the PPM that you could give them, instead of 6.5% or 7% per year, which there is no cash in the development first, you know, few year and a half, then you will give them 9% and then 10%, you know, and then equity gain, you have to give more to average, right, John? Say that again. Yeah.
So what we want to do is stay competitive with other syndicators out there. So we made the average annual return, 18 to 21%, but we did that by giving 0% cash flow year one, 9 year 2, 10 year 3, and then a stronger equity gain. And we made it all preferred, saying, look, we don't get paid until you get your return. That's a highly competitive return right now. And there's no guarantees, but we don't get paid if you don't get it. So we're highly betting on us to do well. So we have to do well. So a lot of people like that.
Uh-huh.
So John, what does your equity multiple end up being like after year 2 or 3 when you guys sell?
So really, like 1.5 or roughly we say 1.6, but equity multiple depends on the time. So you could say your equity multiple is 2.0, but if it's 10 years, it doesn't matter. 3 years. So I like average annual return better, because a lot of people will promote these equity multiples, but if you really look at it, it's 10 years, and 2.0 or 2.5 is good, but 10 years, it's really not.
Nah. So you're doubling your money in 10 years with the rule of 72. If you do 72 divided by 10 years, you are making 7.2%, right? Per year, right? But then if you say equity multiple of 1.5 over 3 years, so now you are saying in 3 years, your money is going to be doubled. So then no, 1.5 times, right? So doubled in 6 years. So that's a much better, way than 10 years, right? So you're right. So the key thing is.
So I'm sorry, Vinney. So if we are to give 1.5 in 2 to 3 years, that's an outstanding return, right? I mean, it is.
Oh, totally. Because you're giving 50% or 51, let's say 51%, right? On the money, you divide that by 3. If it's averaging from the money you got it from the point and to the end, when you give them cash flow and the gain to buy them out or whatever, right? Some refinancing, and you return their capital back, right? You could do that. So that way, you giving them 51 divided by 3, that's 17% per year, right? Yeah.
Okay. Yeah. So we're going to talk to a local developer tomorrow morning. So I was thinking, instead of just doing the returns on his money, I mean, he's probably going to want to be involved.
Okay.
So I'm thinking, what if we just do like a 70-30 split?
Sure.
We'll work getting everything, all the local talent, coordinated and whatnot. And
I like it.
He'll get the majority of the upside and just be a capital partner. It'll help him with preservation and whatnot. And we can bring some tax incentives that he's not going to find with anybody else here.
I love it. That's the best way. If there is one strong investor who's going to come in, then he could be equity partner, big one, which is usually 70-30 split is huge, but then he's not counting on this cash flow and this and that. The whole profit of the LLC, you're sharing 70%, right? That's what you're saying. Yeah. Makes sense.
Yes. So then the neat thing about it, the caveat of working with the development lender that we're working with is like, because in the beginning, we're buying for so much money. So it's 460 for 5 acres. So when we get the first map, then the tentative map, there's quite a bit of work to pay the land development guys, the surveying and all that stuff.
Yep.
So when we go to get the tentative map approved, the
Mhm.
property, the value of the property goes up quite a bit.
Yes.
And then the lender, once we close, that should be complete. And the lender will actually loan according to that value, maybe like 70, 80%,
Excellent.
depending on what we choose to go with. So that will count towards the 20% of equity that we need to
Yes.
bring to the table.
Exactly.
So we might not have to bring very much equity to the table when we close,
I love it. I love it. That's an amazing deal. You bet. The less money from your side in equity, and by doing some of these things, like you just said, drawings, that's a little bit work. It is quite a bit work. But now the value of the land has increased because of your sweat equity and getting the permits and all, right? Yeah. Ordinance changes. And that will then, the lender is going to count that higher price now of that same land, what you're saying, right? In simple terms.
Correct. Yes. So the hard part about it is to write up the offering document or the executive summary, because I don't know how much this stuff's going to cost until we get it through actual the proposal from the land development company and the back end tax impact fees, just the different types of fees that the city's going to charge, and all these different things. That's kind of like an unknown territory as of yet, so it's kind of hard to write it up. But I know from the other local developers here that it's about $45,000 per lot for doing development on a subdivision.
Okay, I know there is like a ballpark number. I know you're a general contractor, so maybe you might be able to save some money on the infrastructure. John, I know we just bought land. You want to share that in Palm Bay? And
yeah, so what we did, so there was 20 acres. We bought 7 to build a community on assisted living community. The other 13, single family home developer built it, and they wanted to cause some issues with easements and different things and not letting us get permits. And so they fell out of contract out of their due diligence period. And we came in and said, hey, sell us the land. We'll pay cash, close. We're going to close probably tomorrow or Friday on it. But we came up and swept it under them. We're getting, I think it was 43 lots, or I forget, I think 43 lots, paying roughly $20,000 a lot. And once we do the land development, sewer, and roadway, we'll be able to triple our money, easily 60 to 65,000 per lot we can sell, or develop them ourselves. So it's a win-win. But in Palm Bay area, it's very needed for homes. There's what I heard is Disney is closing or leaving California. I don't know if that's true. Has anybody heard that?
I don't know.
Someone said Disney's leaving California. I don't know if it's true. But they're moving, and all those employees are going to be moving to that area. So there's going to be a huge need coming soon.
Oh my gosh. Oh, that's something we should do some research. That's
I think Hardy told me that. I don't know if it's true or not, though.
Oh, wow.
I don't think so. Don't say that Disney is leaving California.
I don't think
that may not happen.
Hollywood lots, I think.
A lot of money.
They're kind of like iconic here in California, that's for sure. But they're kind of the caveat just to being around this in California, anyways. But no, so that's great. No, so here we're paying around 15.3 per lot. Oh, I'm sorry. Go ahead.
I'll send a link. So they're moving 2,000 employees. So there is something near Orlando. So I'll put the link in the chat, but they're not closing down. So he did have some validity. So I'll put the link there. Yeah.
Okay. California just keeps looking worse and worse.
Structure, maybe their interior internal staff to run the Disney, maybe moving to more, that place. We don't know.
Vinney, we have one more question.
Buddy? Yes.
How does the cash flow return work when you have refinance and return the equity capital?
Okay, good point. Very good point. So what happens is, cash flow comes from the operation of the property. What's cash flow? It's not the equity. It's not the increase of the loan, right? Refinance, on the other hand, is not from the operation of the property. of course, the operation brought the NOI higher because of rents and all that collections minus expenses. The NOI got bigger. And then the cap rate got lowered. Let's assume now your property is worth a lot more. So you are doing refinancing as a waterfall. We call it waterfall. And then you pull out the debt equity now. So the balance of the loan was up here, but you are taking another loan on top now because you are taking the equity out of that investment and paying more mortgage now, right, Ethan? We are paying more mortgage because now the loan amount is higher. So that amount of waterfall or refinance has to be paid back to the investors as return of capital. Return of capital, not return on capital. Because what's the difference between the two? Return of capital means we are giving their money back from the investment they put in. So now if they gave us 100, we give them 20,000 back after refinance. They only have 80,000 left of their investment. Now, since everybody got proportionately, their ownership percentage doesn't change. It doesn't change at all. But they just got less equity now into the company, the investment. Your cash flow will be based on the 80,000 from this month forward now. So the more money you give them back, guess what? Your property will be smiling. You're making more cash flow, and you can then hit some, targets and all, and start getting paid as the manager also, see, So that's how it is. Refinancing is not a taxation event. That's another thing we should understand, that because we are not selling the property. Taxation happens when we sell the asset, and now the sales price minus the bottom, when we bought it, minus the depreciation. Remember, we have to recapture the depreciation. So the equity gain, that is what will be the taxable event. Refinancing is not a taxable event. Refinancing is taking the dead money out of the property because the property value has gone higher and higher because of all the business plan that you all put in. And that is return of capital. But then the property operations brings the cash flow on a monthly basis. That is return on capital. Long answer. But
yeah, thank you, Vinney. It was me asking the question. I was writing to you because you guys were talking. But if I may just ask, so if an investor puts in 100,000 and you refinance and you give him 20 back, he has 80,000 remaining, right?
Yes.
So when you're saying the property is smiling, if I just understood it correctly, it's because you're giving him less on that 80,000?
Yes. Because
so what happens when you refinance and his equity goes to zero? What do you give him then?
A good point. Very good point.
That was a two-part question. Yeah.
I'm so glad you said it, Gopi. In my case, in 3 or 4 deals, it happened, and we gave investors infinity percentage. Why infinity? Because we returned their whole capital back, and they had zero investment, but the property was making money. So we are still giving them back their portion. Oh my gosh. So whatever we gave them divided by zero is infinity. So they keep on getting cash flow. But I know even Rockcliffe asked me that in the interview many years back. He says, Vinney, how can you give people money, cash flow? They have no stake in the game now. They're only equity partner. I said, you're right, totally. But in our company, we decided they brought us to the dance and we want to keep them paying,
Yeah,
but you don't need to.
Yes, thank you. So this might just be a stupid question, but
No.
So let's say it's 8% of 100,000, that's 8,000.
Mm-hmm.
And then when you refinance, you give them 8% of 80,000.
Correct. Yep.
So you just kind of keep giving them less and less, and when it hits zero, you give them 8% of the total. of their?
Of the 100, no, I would do small number, right? But remember, as you refinance, your mortgage has increased. So mortgage interest and payback of the principal is going to reduce your cash flow also. It's not going to be the same smooth cash flow. So that's why we can pay them less also, right? And then at the 0 point, then maybe by that time it might be even ready to sell the asset. I don't know. But then you could reduce it and they'll be happy to get whatever you give them. As a syndicator, you have the obligation to look at what's needed for the asset to run properly. So it's called disposable cash. Disposable cash. It's not every monthly cash flow that you get to the bank that you have to disperse. Never. You want to look at, have some safe havens, some reserves, some future things coming up, all those things, right? So it's, as a syndicator, you want to, be abreast of that and share with the investors, right? Yeah.
Thank you.
All right. Thank you so much, guys. It was such a pleasure and happy hour time, like every Wednesday. I'm excited. I'm going to make some margaritas. And I got this from, what's that called? Spices, the tray from Amazon. And you could put the lemon, around the bowl. And then you shake it, go like this. And all the salt comes on the rim. I was so excited. I tried that. And that was for $7 from Amazon. It came with the spices and everything and the whole tray. But hey, see you next week. Thank you. Praise the Lord. Thank you so much.
Thank you.
Bye-bye.